Welcome back to Dukascopy TV. Right now I have Michel Girardin. He is head of Thematic Research at UBP, and today we're going to look at the Fed minutes and of course the US economy. So welcome, Michel.
Hello, Doireann.
So first of all, in terms of the Fed, they decided to leave its 85 billion bond buying program. Now this is in order to help the whole problem of unemployment. What do you expect from the Fed this year, and of course what do you think of this announcement?
The policy is consistent with the dual mandate of the Federal Reserve, which is actually the only central bank in the world to both target stability of inflation and also full employment. All the other ones just focus merely on inflation. What they decided yesterday, continue to be proactively buying bonds in order to ensure as much as they can that the unemployment rate will fall going forward.
And yes, unemployment has been obviously quite a big concern. Barack Obama got a lot of scrutiny during the elections. Now how do you see the unemployment rate going? Do you think it will fall?
It will fall, but very gradually. I think the economy is sluggish and is not conducive for much more. The current labor market gains we are seeing will not be such as to lower the unemployment rates towards the goal, which is set by the Federal Reserve of 6.5%. We see that the current data, and we'll have the numbers out tomorrow. We have on average 175,000 job creations per month in the US, more or less. We would need 200,000 plus, which together with a low participation rate would be such as to lower the unemployment rate. But we don't see this happening, i.e. the 6.5, which is the sort of milestone viewed by the Fed. We don't see this goal reached before 2015.
And GDP unexpectedly fell in the fourth quarter. Now, why do you think this was? And of course, what are you expecting from GDP?
Well, as a joke, we can say that if you strip out all the bad news from this report, the GDP number was a good number, actually. So many comments along these lines. They say, oh my God, we see a fall of 0.1, and it was totally unexpected. And then people say, oh my God, yeah, but it was defense, which collapsed, presumably linked to all the cuts in spendings, the automatic cuts, which will happen with the so-called fiscal cliff. And there was also an adjustment in inventories due to Superstorm Sandy. But so if we strip out those two things, defense and inventories, the number don't look so bad. And what is actually encouraging when you dig in the numbers is you look at consumption. It's been growing. It's actually, we can see an improvement in consumption, basically because income growth has been steady, actually the steadiest in the last 4 years. So there are some good news if you strip those one-off factors which we have seen. And you mentioned Superstorm Sandy. Now I know you love photographs.
Yes. So we have some photographs here of the storm. And of course, do you think it really had that much of an impact on the recovery process for the US economy?
Well, the good news about Superstorm Sandy was that it did not hit all the US, and the majority of the country was not affected by the storm. So that's the positive news. And also, okay, it had an impact on inventories, and that curtailed growth in the fourth quarter. But going forward, we would see that growth will gradually pick up. We'll be sluggish, though, and the Federal Reserve, as I said, pointed out to the sluggishness of the recovery. I see a gradual recovery. We expect 1.9% of GDP growth this year.
Thanks, Michel. Now we have a question from Mark Spalti for you. Let's have a look and see what it is.
Hi, I'm Mark Spalti from Dukascopy. My question is very simple. Is gold going to push through the 2000 level in 2013, yes or no?
It will go towards this threshold of 2000. Whether it will break it already this year, I doubt. But it will go in that direction. It would be a massive increase from the current level if it would break through. But we are positive on gold. Maybe short term, what I think does not look that positive for gold is that it seems like it's a crowded trade, and a lot of people are talking in favor of gold.
Yes, Michel, I agree with that, but let's hear what Mark's opinion is on this.
Well, I think the answer is not that simple. On a way, I'm tempted to say, yes, gold's going higher, 2000, here we come and we go even higher. Reasons are, it's one of the instruments that people can invest in the long term and expect it to rise. Now, the reason why I'm reluctant and say I think it's not happening yet in 2013 is the fact that the world economy is not doing so great. Commodity prices are unlikely to rise very much. I think the economy worldwide is not making all that much progress, so price levels are probably going to stay around where we are, and gold is going to stay at around 1600 for the year.
Well, Michel, what do you think about Mark's answer?
Well, I think 1600, which is the current level, I think it will actually recover somewhat from these lows. We were nearing the 2000 last year, and I think we'll go towards that direction. Okay, he says that the economy is not doing so well, which would be the one explanation. I'd say if the economy is not doing well, commodity prices don't rise, and then the gold price will not rise. But that's one side of the thing. Actually, the beauty of owning gold, it's also bound to rise if at some point there are serious worries about the economy, and central banks react to those worries and start really pump-prying the economy and using, you know, the money supply to really inject a lot of liquidity in the system, in the economy, to the point that there are sort of inflation fears, and if inflation fears, if people start anticipating higher inflation, gold will rise in reaction to that, because it will be perceived as the ultimate currency to own.
Thanks, Michel. And now, last time for a Dukascopy question, you spoke to Jennifer Cordinley and she asked you, if you had $1 million, where would you invest it? You said equities. Now let's have a look at some allocation charts and see what it looks like. Well, Michel, last time for our Dukascopy question, you did choose equities. Now, are you still feeling quite bullish about equities?
Yes, indeed. It would be my preferred asset class going forward, equities.
And let's have a look at this graph. Now, what else would you be quite bullish about?
We like equities at this juncture because they have never been so cheap if we compare it to bonds. But we still like bonds for diversification purposes. And there's some areas in the bond market which we like, not so much the government bond, but also the corporate and emerging market debt. So this would be the second allocation we would make in a diversified portfolio.
And many are very bullish about gold.
Indeed, and so are we. Well, if the economy will surprise on the upside, commodity price will rise, hence gold will profit from this trend. Vice versa, if economies will be weak going forward, but if, as expected, central bank keep pump-prying the economy and injecting all this liquidity into the system, at some point we could fear some inflation. If inflation start to rise, or the expectations about inflation start rising, then gold will be rising as well, because it's the ultimate currency to own.
And finally, Michel, how do you feel about real estate?
Real estate we like. We think the trend has already been played in the US. We've seen substantial performance of real estate investment trusts in the US, REITs. And in Europe, there are still some pockets which could be of interest, specifically Germany. There's some fear there that we could be in a bubble, a bit like in Switzerland in some areas. But actually, if you look at price to rents in Germany, they're not in bubble territory. The problem is, and we've seen already in Germany problems with that, it's liquidity. There are not many vehicles to play the German real estate market which are liquid enough in our view.
Great, thank you very much, Michel.
Thank you.
Well, do stay tuned to Dukascopy TV for more economic analysis and Forex updates. But for now, goodbye.